Hello, Ida. How are you today?
Hi.
I was checking all the information that I received from different respondents, and I was interested in interviewing with you since you're a good friend of mine, and we know each other from background and we know each other. So I was looking at the questions you answered to my questionnaire, and I figured out you're not really familiar with derivatives or financial market as a whole. Is that right?
Yeah, that's true, but I still want to know that about more and more.
Yeah, I see. Also, I heard you get an internship at TF company. Is that right?
Oh, yes, yes,
Wow,
exactly.
congratulations. Were you working today?
Thank you so
Because
much.
today was a public holiday, right? Or it was your holiday too?
Yeah, I've been working. Yeah.
Oh, you were working?
Yes.
All right, so I won't make today more exhausting as it was already. Okay, let's dive in. I'm going to talk about
Okay.
derivatives in a friendly tone, and I won't make anything any complex. Everything is as simple as possible. So let's dive in.
Okay.
All right. Sorry, this is the first slide. So the first slide, I'm going to talk about what are derivatives as a whole. Derivative is a contract that gain its value from an underlying asset. What I mean by underlying asset, for example, if you buy a derivative contract, for example, gold contract, its price derived from underlying asset, which is gold. So, for example, you assume that the price of gold will be $50 more than what it is today. And you don't want to buy actual gold. You don't have time to go and buy an actual gold. Also, you don't have a place to reserve any gold. You just know that for a fact, gold is going to be more expensive. So you can just easily buy a derivative contract, and if your projection comes true, you can benefit from increase in the price of gold. For example, you bought it in $1,000 and turns out to be $1,050 next month. You can just gain $50 easily without having the actual gold with yourself. Do you understand what I mean?
Yeah.
And it's not only about gold. Derivatives ranging from so many different things. It's in agriculture, corns, everything you think about it. It usually, for agriculture, is usually traded in countries that are active in agriculture sector, and oil and currencies as gold is usually taking place in most of the countries. Next, I'm going to talk about future, which is a financial instrument. Uh, and you have to know three key concepts if you want to completely understand about futures. You need an initial margin in order to enter to a contract, as you can see in the slide, a security deposit to show you can handle losses. Let's make some examples so we have a better illustration. You have $1,000, right? This is your initial margin. And you enter into a buy contract, right? Let's stick with the gold
Yeah.
example. You know for a fact the price of gold is going to increase in a certain period, for example, next quarter. You need $1,000 to buy a future contract, and your maintenance margin is the level of price. For example, you buy the gold and I'm not gonna use the word collapse, but it reduces in the value. So you buy in $1,000, it reduces to $900. So your margin become lower, right? And then when this happens, you need to top up on your balance to increase it in the initial margin. That's the maintenance margin. Did you get it, what I mean?
Yeah, I'm
Yeah.
not.
And the other key concept you need to be familiar with is mark to market. It basically means after end of any day, any trading day, The value of your margin, as I mentioned earlier, it's calculated day to day, and its value start to be reset. So it can be calculated, your initial margin, maintenance margin, and so forth and so on. That's about it. Continuing with the users of futures. It has more than these two, but these two are the major users in futures market. Starting with hedgers. Hedgers are not in the future markets mainly to make any profit. They won't do that for its profit. They usually hedge their risk. For example, if I make an example, also you can see it in the slide. The airline hedge jet fuel prices to avoid unexpected increases. The airline consumes a tons of fuel for their activity. So if they expect an increase in the price of oil or gas or anything related to their operation, they could just easily buy a future contract. So if the price increase, they can earn some profit, so it can offset their losses in their operational costs. The other group is speculators. Speculators are in the market mainly for making profit. They absorb the risk that hedgers are trying to avoid. Do you get what I mean?
Yeah, I understand.
That's what they do. Also, in the derivatives, people don't use like a buy term or sell term, as you can see in the slide. When they want to buy something, they call it long or they call it short when they want to sell something. So, for example, in this example, airline can long a future contract in order to offset their losses if the price of fuel goes up. That's all about it. Now let's a little bit talk about options. So everyone that is not that familiar with derivatives might confuse or mix up options with futures. So basically, these two are really similar, yet they have some fundamental differences. One of the main differences between future and options are their obligation. In the earlier examples, future has obligation. For example, at a certain period, you have to meet the settlement. For example, you bought the gold in my example. If you don't close your position, for example, after 3 months, there either could be a financial settlement or physical, like commodity. If you bought the gold, you need to buy the actual gold. You go to a place and receive your gold, something like that, to put it very simple terms. But in options, it's not the case. There is no obligation. You have the rights, as the name is self-explanatory. You have the option to exercise or not exercise. In the next slide, I will explain when it's better to exercise or not. Also, we use
Okay.
new terms instead of buy or sell. Finance people love to make things complicated. I don't know why. Now, in the previous example, long was for buy. Here is call. So if you expect the price to go up, you can say I use a call option. And the opposite is put for selling, for shorting. Put is for
Okay.
when you expect the price to go down. And
Okay.
the other difference in an option, when you buy a contract, the maximum you may lose is the premium you paid. Because in options, you have to pay a premium. For example, if you want to buy a contract of gold worth of $1,000, for example, you need to pay $15. This is the premium. And if
Okay.
the market didn't act in your favor, you could just easily don't exercise and just assume the premium you already paid is gone. That's the maximum you can lose. On the other hand, the profit possibility, the potential to earn money has no limit. You can earn. If the price of gold is skyrocketing and it happens you have a call option, you can earn as much as the price goes up. That's all about it. So here I explained a little bit about intrinsic value. Don't be scared about the bombastic name. It just means how much is truly the value of something. For example, gold. its actual value in the market. Here, there is a term about time value. So I said there is a specific time for options as well as futures. For options, there is a time value, for example, 3 months from now. As the time pass by and we get closer to the that specific time, the value become lesser and lesser because the window for changing in the prices become narrower. So as we have more time, the time value is higher, that reflected into the price. So the higher time, the higher price. That's all about time value. Here is moneyness status of the option. I tell you earlier when we need to exercise and when we don't need to exercise. There is a term ITM in the money. You would be profitable if exercise now. For example, you call at 1000 and the price is 1050. So you're already high in profit, something about $50. Let's not include your premium because that's your cost. You have to pay the premium, right? As you can see here on the bottom, the calculation. You can see that, right?
Yeah.
So in that scenario, you need to exercise, or it's better to. There is no obligation, as I mentioned. You have the right to exercise and gain your profit. And you can see the formula, how much will be your profit. And in a bad day, you could just stay out of the market, in out of the money option. You are not profitable now. You can just forget about it, and you already lost the premium. That's all about it. Following by warrants, something which is really um, really famous in the Malaysia. Um, a structured warrants is really similar to option. Everything I explained about option so far, with a little bit difference. So warrants are usually more volatile compared to their underlying asset. For example, let's talk about the Petronas stock. If the Petronas stock moves 2%, its warrant might increase more than 2%, 5%, 6%, anything. One of the reasons is because of leverage. So it enhances the movement. It makes it more appeal to somebody. Also, it might increase and it will increase the risk because with higher risks, with higher rewards comes higher risks. And it's very appealing for people because it has lower upfront cost. As I mentioned, high sensitivity to price movements. But something really important about warrants that you have to be careful is their expiry date. Let's have an example. For example, you are going to buy a warrant at the time being, and the expiry date is 1 month from now. If you don't exercise your warrant and it goes to expiry date, it become worthless, no matter how much is the price or the value. So this is something crucial that everybody that is active in derivatives markets, especially warrants, must be aware of. That's about it. And last but not least, I want to spend some time talking about some ethical dilemmas in derivatives market. First and foremost is insider trading. You might heard it because there are some famous cases about insider trading. They usually end up in jail or courts, or they have to pay a huge amount of compensation because they usually take disadvantage of information that they have in a company and make money, which is illegal. The next is market manipulation that some rich company or rich entities try to increase or decrease the prices in their own benefit at the cost of other people's money. The third one is misleading financial influencers. You might come up with so many different and fake TikTok or Instagram or Facebook pages that advertise as a way that you could just make millions of dollars in less than a year. Some get really quick rich schemes, something like scams. These are ethical dilemmas, and these are really important to be aware of because of as a broader picture. It makes the whole financial system more safe if everybody are aware about that situation. And all of us need to ask some self-reflection question in order to address these ethical issues. Am I following credible sources or am I falling into the scammer's trap? Am I trading emotionally or responsibly? Before I start to invest my own money, did I attend required educational sources? And lastly, could my actions harm others financially? That's the question. If everybody asks themselves, nobody gets scammed. So that was all about it, Ida. Thank you for listening. And now I open the floor for you. If you have any questions or any misunderstanding, it's time to ask. And after that, if you have no questions right now in your head, I can ask some feedback from you.
Yeah, thank you. I learned so much. Really appreciate it. And I feel inspired to learn more about it. Thank you.
All right. So, if you don't mind, I want just ask really quick, some like about four or five
Yes,
feedback
sure.
questions. All right.
Sure.
So, how clear was the explanation of futures for you? Did the idea of margins and daily mark to market made sense for you? Did you understand it properly?
I understood the general idea, but I'm still not fully clear about the merging part.
Mhm.
The daily mark to market makes sense in theory, but I think I need hear it one more time or two long and short position were okay though.
I see. Thanks for your answer. After hearing the explanation, do you feel you understand the difference between, particularly not the whole difference, I feel that, but any level of difference between a call and a put option and how options are different from futures?
I kind of understand what call and puts are, but I'm still not totally confident the part of option give you a choice while feature force you to buy or sell was clear. But the time value I think is still confusing. Um, I
What
don't know
about it
exactly
is
what is
confusing for you, like about the time value? So what is your question about that exactly, so I can make it clear?
What does time value always decrease as a expiry gets closer, or
That's
can
right.
increase sometimes?
That's right. It always the time value. So when we get closer to the expiry date, the time value decreases. So, for example, that specific contract become less valuable as it get closer to the expiry. That's the case in 100% of the time. That's about it. Yeah. Um, so how did you feel about the explanation of structure warrants? Do you think the risks made sense, especially how fast warrants can lose value, especially due to the leverage?
Um, I get a basic ideas, but I feel very confusing because it's very similar with the option. I think so, yeah. And but I think I need another explanation before I feel comfortable for them. Yes.
I see. Um, Last question from you, Ida. We talk about ethical dilemmas. Which ethical dilemma, in your opinion, was more related to Generation Z? All of us are from Generation Z. So, what
Yeah.
trap do you think is more likely that the people put their feet into it, and which one is more prominent issue in your opinion?
In my opinion, the influencer one is out of the most because it's feel most real and the Gen Z is all the times in the social medias and just like that and I can is affected more. I see a lot of people giving financial advice online in the YouTube or in the Instagram and honestly it's a hard tell who's the trust versus. So that part made it most sense to me. Yeah.
Thank you very much, Aida.
Thank
Thank
you. Thank you
you.
so much.
Bye bye.
Bye.